Hello friends, welcome back to JK Shah classes. Today we will be completing revision of capital gain chapter, the third and the last part for CA final AY 25-26. I am Professor Nihit Jhaveri. I welcome you back on behalf of JK Shah classes. Now in capital gain chapter, in the previous two sessions or previous two parts, we finished almost the whole chapter. Now only two things are left out. 9 special situations where capital gain is to be computed in a slightly different manner. 9 special situations. Out of them, we are done with, I think, 3 or 4. We are done with section 50C, 50CA, 50C was done, 50CA was done, 50D was done, and 51 was done. Out of these, total 9 situations, 4 are done, 5 are left out. And thereafter, exemption under section 54 series. Out of total exemptions, there were 9 exemptions earlier, section 54 till section 54 GB. 54 GB has already come to an end. Our institute has officially removed it from the module. So 54 GB not to be done. So there are 8 exemptions under section 54 series. Out of them, 2 or 3 are very important, section 54, 54F and 54 EC. These are the only 3 which actually come in the exam at CA final stage. So we will be focusing more on these 3. And out of special situations, out of 9 situations, 4 are done, 5 are left. Let's proceed further. Going backwards, going back to the first situation, which is randomly picked up some small situations to cover up our part 2. Now the first situation is about section 50 and 50A. Computation of capital gain in case of depreciable asset. What is depreciable asset? Depreciable asset means that asset on which depreciation is allowable, whether claimed or not claimed. It's very simple how to compute. So in case of depreciable asset, section 50 read with section 50A is very simple. Indexation not allowed. Indexation is not allowed otherwise also, but that is on or after 23rd July 2024. But even earlier also, even if the depreciable asset is transferred up to 22nd July 2024, then also depreciation will not be allowed. Gain or loss will always be short term. There cannot be long term, even if the period of holding is much more than 24 months or 12 months or 36 months. Then also, and cost of acquisition will be allowed, but cost of acquisition plus cost of improvement will not be equal to original cost of acquisition, will be equal to WDV of the block, WDV of the entire block. So it will be gross sale consideration minus transfer expense, brokerage, stamp duty, registration charges, etc. Balance will give us net sale consideration. From the net sale consideration, simply subtract in the name of cost of acquisition and in the name of cost of improvement, both combined together will be equal to the WDV, but WDV of the whole block, not the WDV of that asset individually. WDV of the whole block. Balance will give you short-term capital gain or short-term capital loss. It's very simple. The only thing which is to be computed is how to compute this or how to find out the WDV of the whole block. And there are some restrictions. Understand, indexation not allowed. This is something you need to remember. Applicable in case of depreciable assets only. No indexation benefit, no distinction to be made between short term, long term, everything will be always short term. Gain or loss is to be computed not only for the asset which is transferred, but gain or loss is to be computed for the entire block of assets as if the whole block has been transferred. The way we compute depreciation under PGBP head, not for one particular asset, but for the whole block of asset. Same way here, computation of capital gain has to be for the, not only for the asset which is transferred, but for the whole block. Cost of acquisition and improvement will be equal to WDV. How to compute? So WDV to be computed by following technically only 2 steps. In case of depreciation PGBP, if you recollect, the depreciation was to be computed by following 3 steps. Opening WDV of the block plus purchases minus sales. Obviously, purchases are called by different name and sales is called by a different name. It is only for our understanding. Opening plus purchase minus sales. Balance WDV that you get, on that we charge depreciation. Here, instead of following 3 steps, we just have to follow first 2 steps, opening plus purchases. So opening WDV, add purchase or actual cost of acquisition of the asset forming part of this block, purchased or acquired during the previous year. Balance will give you closing WDV. This WDV is to be picked up or will form cost of acquisition. Then full value of sale consideration, that is gross sale consideration minus transfer expense, brokerage, etc. Net sale consideration, cost of acquisition and cost of improvement will be equal to WDV of the block. However, there will be problem. The WDV of the block is, for example, 13 lakhs. WDV is 13 lakhs of the whole block. In the whole block, there are 13 assets and 13 lakhs is the WDV. Out of 13 assets, I am selling only one of the asset for 2 lakh rupees. Transfer expenses are 0. My net sale consideration is 2 lakh rupees. Now here, I am selling only one asset out of 13 assets. But because of selling one asset, if I have to subtract WDV of the whole block, then I will have a loss, short-term capital loss. However, as per system, loss should not be there. There shouldn't be loss. Either the answer should be positive, that is short-term capital gain, or the answer should be 0. Loss should not appear unless and until all the assets of the block are sold off. If all assets are not sold, then cost of acquisition, which will be WDV of the whole block, that WDV 13 lakh will have to be restricted to net sale consideration. Please remember this is the key point. Barring that, everything else is simple. So, cost of acquisition as computed in the above table, which will be equal to WDV of the whole block, restricted to the maximum amount of net sale consideration. Net sale consideration is 2 lakh rupees. 2 lakh rupees. Our cost of acquisition was going to be 13 lakhs, but 13 lakhs restricted to 2 lakhs, so that your answer becomes 0. Loss should not be there unless all the assets of the block are sold off or transferred. If all assets are transferred, then only there can be loss. That's it. Short-term capital gain, no long-term, irrespective of period of holding. That you need to remember. And another thing you need to remember is cost of acquisition will be equal to WDV of the whole block, but restricted to the amount of net sale consideration unless all the assets are sold off. I have given 4 examples in the regular class. Next is section 50AA, which was introduced last year only, AY 24-25. There were 2 assets here, 2 more added from the current year, totaling to 4 assets. For these 4 assets also, the gain or loss will always be short term, irrespective of period of holding. Indexation not allowed, and the gain or loss will be short term. While computing units of specified mutual fund or market linked debentures, MLD, market linked debenture, while transferring, and 2 more assets newly introduced. Market linked debentures is one thing, MLD acquired at any time, or units of specified mutual fund acquired on or after 1st April 2023. You will have to remember this date. If acquired before 1st April 2023, then this rule will not apply. Section 50AA will not apply. What is specified mutual fund? Specified mutual fund means a fund where not more than 35% of the allowable or the investable funds, not more than 35% is invested in equity shares of domestic company. Not more than 35% is invested. If you recollect, equity oriented funds, EOF, units of equity oriented fund, when it is called equity oriented fund, units of equity oriented fund means a situation where more than 65% of the available funds or investable funds are invested, more than 65% are invested in equity shares of domestic company. And what do you mean by specified fund? Units of specified fund means not more than 35%, that is less than or equal to 35% is invested in equity shares. However, this definition is slightly changed from current year onwards in equity shares. So, if more than 65% is invested, then the units become equity oriented. If less than 35% or up to 35% is invested, then it will be called as in equity shares, then it will be called as specified fund or units of specified fund. Instead of 35%, now the definition is changed. That earlier definition is slightly changed. Now the new definition is not more than 35% or maximum, or the negative definition, 65% or more than 65% is invested in debt security. Such units of such a fund where more than 65% is invested in debt security. which is same as earlier definition but slightly changed. Okay, and the next item, two items added, unlisted bonds and unlisted debentures acquired at any time. Acquired at any time, the date of acquisition matters only for the purpose of specified mutual fund units which should have been acquired on or after 1st April 23. Unlisted bonds or debentures could have been acquired at any time, should have been just transferred, redeemed, matured on or after 23rd July 24. 23rd July 24, the second half of the budget which was announced after elections got over, that is Finance Number 2 Act 2024. Here two items are added. For these four assets, what will happen is, I'll tell you. For these four assets, the capital gain is to be computed as if they are short term. Cost of acquisition allowed, transfer expenses allowed, indexation not allowed. These are the only 3 points to be remembered. Cost of acquisition will be equal to original actual cost of acquisition, but deduction will be allowed for these two items. No deduction for anything other than these two. Okay, these four assets you will have to remember. This is slightly an important section, especially market linked debenture definition and the definition of specified mutual fund. What is specified mutual fund? Specified mutual fund means mutual fund where not more than 35% of total available funds, total proceeds, is invested in equity shares of domestic company. But from AY 25-26, meaning is slightly changed. Such a mutual fund where more than 65% of the total proceeds are invested in debt securities or money market instruments. What is market linked debentures? MLD. Market linked debenture means such debentures where the rate of return or the rate of interest is dependent on, or it is linked with some other market. Say it's linked with Sensex or linked with Nifty index, etc. For example, recently one of my client purchased some market linked debenture whereby he acquired debentures where the rate of interest would be rate of return on Nifty return plus 1%. Then in such situation, such debentures will be called as market linked debenture. This concept is gaining popularity. It's a very popular concept, but now gaining popularity. That rather than investing in stock market directly, you have another option to invest in mutual fund units. But rather than investing in mutual fund, third option will be this, where your rate of return is somewhat fixed, 1% above and over the Nifty return. Then it will be called as market linked debentures. Gain arising will be always short term. Third is capital gain in case of units of specified mutual fund. This is done. Okay, here cost of acquisition will be allowed, indexation not allowed, transfer expense allowed, cost of acquisition allowed, indexation not allowed, STD not allowed, and gain or loss will always be short term. That is what you need to remember. Slump sale, very important, 50B. So we are done with section 50A for depreciable asset, 50AA for 4 assets including market linked debentures, units of specified mutual fund, unlisted debentures, unlisted bonds acquired at any time. Slump sale, which is a bit lengthy. Slump sale means a situation where the entire undertaking or the entire division or entire unit of the assessee is transferred for a lump sum figure, for a lump sum amount, without bifurcating the sale consideration amongst the assets which are sold. So for example, if somebody has got 3 divisions, X Limited has got 3 divisions, division A, B and C, only division C is sold or undertaking C is sold. It is sold, it contains 300 assets. So assessee will have two options when the entire undertaking is transferred. Either calculate capital gain on all 300 assets individually, which is called itemized sale. Either calculate capital gain under the concept of itemized sale, that means calculate capital gain for each item individually. Or second option is shortcut way, slump sale. However, slump sale will have its own pros and cons. So assessee will have to every time work out which option is beneficial to him, and then he can choose whatever he wants to. It's optional. Slump sale is not mandatory, it is optional. What is slump sale is defined in section 2 clause 42C along with explanation to section 2 clause 42C. Slump sale means a situation where there is a transfer of one or more undertaking. Undertaking can be called as a unit also. By any means. Earlier it was by means of sale. Now instead of the word sale, Nirmala Sitharamanji has changed the language. Now by any means. That means there need not be actual sale, there need not be money received, there could be exchange also for a lump sum consideration, but without values assigned to individual assets and liabilities. if liabilities and assets are individually bifurcated, that means if I am selling the whole unit with 300 assets and I am receiving 300 crore rupees, and if I bifurcate that out of 300 crore, how much is for this asset and how much is for that asset, then slump sale concept cannot be applied. I have to compulsorily go for itemized sale. If sale consideration is not assigned to each individual asset or not bifurcated amongst each individual asset transfer, then in that case one can go for slump sale. But slump sale is optional. Here indexation will not be allowed, but gain or loss will not be short term. Gain or loss can be short term or can be long term depending upon period of holding. Period of holding of the whole undertaking or the whole unit. If the period of holding is more than 36 months of the entire undertaking which is transferred, then the gain or loss will be long term. And if the period of holding is up to 36 months, then the gain or loss will be short term. Here, instead of 36 months in this whole chapter, 36 months is replaced by 24 months, but except of this place, here 36 months remains 36 months. Here, Nirmala Sitharamanji has forgotten to make changes, and now Income Tax Act is going to be replaced by Income Tax Bill. Therefore, forget about the changes. This will be your attempt where no changes are made. Here, still it continues to be 36 months in order to be called as long term. But we have to see the period of holding of the whole undertaking, not of each individual asset. It's quite possible that some of the assets under the undertaking might be short term, recently acquired, and some assets might be very old, acquired 50 years back. Come what may be, the gain or loss will be either long term or short term depending upon only one factor, period of holding of the whole undertaking. Indexation will not be allowed. Indexation is not allowed on or after 23rd July 24 otherwise also. But even if undertaking is transferred before 23rd July 2024, then also indexation not allowed. Cost of acquisition and cost of improvement. For depreciable asset, cost of acquisition plus improvement will be equal to WDV. Here it will not be WDV, here it will be similar to WDV, here it will be net worth. Net worth of the undertaking which is transferred. Meaning thereby, net worth will comprise of some depreciable assets, some non-depreciable assets. Indexation not allowed, but how to compute net worth? So that will depend upon which asset are you calculating the value for. Of course, net worth would mean the standard definition, assets minus liability. Assets minus liability. But how to compute the value of assets, how to compute the value of liability, that we are going to discuss. So in this entire concept, it will be sale consideration, net sale consideration, that is after transfer expense, minus net worth of the undertaking. Technically only two lines it gets over in. However, earlier the net sale consideration had to be by way of monetary consideration only, because as per the definition of slump sale given earlier, it had to be transfer of one or more undertaking. Now it is by any means. Earlier, instead of any means, it was written that by way of sale. By way of sale. That means exchange was not covered. Exchange or relinquishment or extinguishment etc. were not covered, only by way of sale. That means consideration had to be monetary consideration only. But instead of by way of sale, Nirmala Sitharamanji has changed it and made it by any means. Transfer of the undertaking by any means. That means there can be actual sale, exchange, relinquishment, extinguishment, compulsory acquisition, could be anything. Therefore, now the consideration which is received may not necessarily be monetary consideration. It will be monetary as well as non-monetary. There could be combination of both. So how to compute net worth? Net worth is to be computed in the following way. So fundamentally, the capital gain computation will get over in two lines: net sale consideration minus net worth of the undertaking. For net sale consideration, Nirmala Sitharamanji 3 years back, she brought some new concept. What is it? We will discuss. But before that, how to compute net worth? Net worth is to be subtracted from the net sale consideration. Net worth would mean assets minus liability. But what do you mean by assets and what do you mean by liability? Assets of the undertaking. Understand, it is not assets of the assessee. Assessee has 3 division or 3 undertaking, A, B and C. Only C is sold. So that means assets of only undertaking C. Same way liability of the undertaking which is transferred. Assets value to be computed as per Income Tax Act. But as far as liabilities are concerned, the value to be computed as per books of account and not as per Income Tax Act. Assets minus liability. Asset as per Income Tax Act, liability as per books of accounts, BOA. Of course, liability as per books of accounts or as per Income Tax Act will be remaining same almost. Say if I have to pay you 10 lakh rupees, then I have to pay you 10 lakhs only. Whether it is as per books of accounts or it is as per Income Tax Act, the figure is not going to be different. But ideally, for liability, we take amount as per books of accounts. For assets, we take value as per Income Tax Act. For Income Tax Act, if it is a depreciable asset, take WDV. If it is a non-depreciable asset, take book value. And in case if it is such an asset whose entire cost is already allowed as a deduction, 100% deduction, then the cost of acquisition while computing net worth will be nil. So only three possibility, either WDV or book value or nil. What to do, that we will discuss in some time, but before that, this formula net sale consideration. What I was telling you was that earlier, since the transfer had to be by way of sale only, therefore consideration was supposed to be monetary consideration, so there was no problem. Now the consideration can be monetary or non-monetary or combination of both. Since there can be non-monetary consideration also, therefore according to new concept 3 years back, we will now have to find out the FMV of the things which are received. So now we'll have to find out the FMV of two things: assets which are given away or transferred, which are a part of the undertaking transfer, as well as FMV of the assets received. Sale consideration will be equal to higher of the following two. Sale consideration with effect from AY 21-22. So 21-22, 22-23, 23-24, 24-25 and now 25-26. This is the 5th year. So amendments were made not 3 years back, 4 years back. FMV 1 versus FMV 2 to be computed as per Rule 11 UAE, Sub Rule 2 and Sub Rule 3. One by one we will be discussing. What is FMV 1 and what is FMV 2? Up to Inter CA level, FMV 1 and 2 were to be given in the exam directly. You were not required to compute. But now at final CA stage, you will have to compute both. This is FMV of the assets given away, assets transferred in the slump sale or given away. Say I have got 300 assets in the undertaking. I am giving away 300 assets. So this will be FMV of those 300 assets. And on the other hand, FMV2 would mean FMV of the assets received. That is non-monetary consideration received under slump sale. So out of these two, whichever is higher will be considered as my sale consideration. So FMV of the assets which I am giving away is worth 302 crore market value, and the assets which I am receiving including monetary compensation is 300 crore as we discussed earlier. In such situation, for the purpose of calculating capital gain, the sale consideration will be higher of these two. 302 crore will be considered as my sale consideration. So FMV1 formula is there: A plus B plus C plus D minus L. We know pretty well L is equal to liability. Liability is to be subtracted. A plus B plus C plus D, all four of them are 4 different types of assets. One by one we will be discussing. So let's first start with BCD. BCD, then we will come to A. A is supposed to be taken up at the end. What is BCD? B, C and D are nothing but market value of different assets, 3 different types of assets. If it is jewelry or artistic work, then you take FMV as per valuation report of registered value, FMV. If it is shares and securities, again take FMV, but this time FMV will be certified by or calculated as per Rule 11 UA methodology, certified by a chartered accountant or a merchant bank. So for B and C, which are 2 different types of assets, take FMV. But which FMV? For jewelry and artistic work, take FMV as per market value, real FMV. For as far as shares and securities are concerned, whether listed or not listed, find out value as per Rule 11 UA. So I am X Limited. When we talk about shares and securities here in point number C or part C, we are not talking about my own shares being a company. I am talking about, or here we are talking about assets which are given away. So here we are talking about shares of X Limited is holding shares of P Limited. So here we are going to value the shares of P Limited. These are to be valued as per Rule 11 UA, not the shares of X Limited. Why would we value or why would we find out the value of X Limited shares? X Limited is not getting sold, no? Only one of the undertaking of X Limited. Out of 3 undertaking A, B, C, only undertaking C is getting transferred. Pointless to value the whole company. or the whole assessee. Here we have to find out the value, that is FMV, of those shares of some other company which are held under undertaking C by X Limited, and D is equal to stamp duty value of immovable property. So to conclude it, if it is immovable property, take stamp duty value. If it is shares and securities, take FMV. Jewelry, artistic work, then also take FMV. 5 assets we have talked about here: jewelry and artistic work, shares and securities, and immovable property. For immovable property, we always end up taking stamp duty value, you know pretty well. And for all other assets, all the other assets other than these 5, jewelry, artistic work, other than jewelry, other than artistic work, shares, securities, and immovable property, you take book value. Book value, that is the value appearing in books of accounts. If it is a depreciable asset, then the value appearing in books of account will be WDV. WDV as per books of accounts, not the WDV as per Income Tax Act. WDV as per your accounting principles. And in case if it is a non-depreciable asset, then the value appearing in books of accounts would be cost of acquisition. For depreciable asset, it will be WDV as per books of accounts. For non-depreciable asset, it will be cost price or the book value as appearing in the books of accounts of the undertaking or division which is transferred under slump sale, reduced by the following 2 items which relate to the undertaking or the division. 2 items to be reduced from the book value of assets other than 5 assets. Number 1, income tax paid minus income tax refund. Income tax paid minus income tax refund, if any. And second is unamortized expenditures, that is preliminary expenditures to the extent not written off. In accountancy subject, we call them as preliminary expenditures to the extent not written off. Here we will call it as unamortized amount of deferred expenditure. These are nothing but deferred revenue expenditure or preliminary expenditure, pre-commencement period expenditure, which are not entirely written off and are appearing on the asset side of the balance sheet. Since we are taking book value, we will be referring to balance sheet. These are those assets which do not represent any value of any asset, can be called as fictitious assets. 2 items to be reduced from the value of assets, and for these 5 assets divided into B, C and D point, we take market value. For immovable property, market value will be stamp duty value. L is a liability. For liability, we have to consider value as per books of accounts. As per books of accounts, but which liability? Liability of that undertaking or the division which is transferred under slump sale, but excluding 6 liabilities. 6 items appearing on the liability side which are actually not external liability or they are not real liability. Same 6 items were there in charitable trust chapter also when we discuss exit tax or tax on accreted income. Same 6 items are there in rule 11 UA when you are valuing shares, debentures or shares of securities. Simply 6 items which are technically not your liability or not an external liability. With 6 items, number 1, paid up share capital in respect of equity shares, only equity shares, not preference shares. This is owner's capital including reserves and surplus. Third point, which are nothing but these 2 items combined together: equity share capital, that is paid up value of equity share capital, and reserves and surplus, RNS. These 2 items are called equity capital or they are owner's capital. They are not external liability. Just because they are appearing on the liability side, you can't subtract that. If you subtract everything, then your net worth will become 0 always. Second is amount set apart for payment of dividend, whether on equity shares or on preference shares, provided such dividend was already declared. But you subtract only if dividends have not been declared before the date of transfer of undertaking or the division. If dividends are not declared, then you subtract it. Then it does not represent your actual liability. If dividend is not declared, but then also you have segregated it, you have reduced it from reserves and surplus and shown in the balance sheet separately, then it is still forming part of owner's capital. So these 3 items are owner's capital. Next is especially 5th and 6th item, provision for unascertained liability and contingent liability other than arrears of dividend for cumulative preference share. These 2 items, contingent liability or unascertained liability, they are not your actual liability, they are contingent. Ideally, they would not be even appearing in the books of accounts, they would be appearing as a footnote, but by chance if it is appearing in the balance sheet, just ignore it, they are not your real liability. First 3 are owner's capital, not a third party liability, therefore we do not subtract them, not a third party liability or not an external liability. And 4th, 5th and 6th item, these items are either contingent, unascertained or they are in the form of not a real liability. Provision for taxation other than income tax paid minus income tax refund claim, to the extent such provision is over and above the tax payable on book profit in excess of provision of income tax over and above book profit. Ideally, this would be deferred tax liability. These are not your real liability. Not real liability, therefore you don't subtract them. Out of these 6, any one of them will be given in the question. Okay, so this is summary of Rule 11 UAE, Sub Rule 2 and Sub Rule 3. Sub Rule 2 is a FMV1. FMV1 means FMV of the assets given. FMV of the assets given away or assets surrendered or transferred under slump sale. A plus B plus C plus D minus L. So A is equal to, or rather I'll start with B. Jewelry artistic work, take FMV. This is B point. Shares and securities again take FMV. This is C point. Immovable property takes stamp duty value. This is D point. All other assets is point number A, take book value, but ignoring 2 items. Income tax paid minus income tax refund, and secondly unamortized deferred expenditure or deferred revenue expenditure or preliminary expenditure to the extent not written off from the books of accounts, which represent actually fictitious assets. Fictitious assets are those assets which appear on balance sheet asset side but are technically not your assets. And minus liability, liability other than 6, but liability value should be as per books of account other than these 6. First 3 are owner's capital, next 3 are not real liability. Then Rule 11 US Sub Rule 3 FMV2. FMV2 means FMV of assets received. FMV of the assets received. We already discussed about this, but reminding you once again. E plus F plus G plus H, total of 4 items. F number, F, G and H are the assets received. E means monetary compensation. Monetary compensation means money received, which is not required to be valued because it has its own value. It's a monetary compensation, money received, no need to value. Add FMV of the assets received, number F, number G, number H, FMV, FMV and stamp duty value. Same thing as we discussed for FMV1. FMV for those non-monetary consideration which are accruing or arising as a result of transfer, but which is in the form of those properties which are referred to in Rule 11 UA. Whatever is covered by Rule 11 UA which is received, then find out the value as per Rule 11 UA, ideally shares debentures. So if I am transferring my 300 crore worth of assets under slump sale, but the other party is not ready to pay compensation by way of money, not ready to discharge by way of paying money, but the compensation is discharged in the form of shares of that company. In such situation, I will have to find out the value of those shares as per Rule 11 UA. Supposing I am running a coaching class and some Reliance Industry takes over or purchases my company, all assets are taken over, but they decided to pay 300 crore, but 300 crore is in the form of my company shares. Then in such situation, what will happen is, you find out FMV as per Rule 11 UA of the shares of that company. Point number G is again FMV, but FMV of those assets which are not referred to in 11 UA, other than shares, debentures, mutual fund units, other than investment. Then in such situation, for such non-monetary consideration which is in the form of movable property, which is not referred to in Rule 11 UA, then find out the value as per valuer's report, which could be chartered accountant or which could be merchant banker. Here registered valuer's report will be required. Registered valuer ideally would be a merchant banker. And last item, stamp duty value of immovable property. If it is immovable property, take stamp duty value. Summary is as follows. 4 assets. Number 1, if it is monetary compensation, then what do you do? For monetary, valuation is not required. If it is asset, we divide them into 3 categories. If it is immovable property, take stamp duty value, matter over. For movable property, find out whether covered by section or Rule 11 UA or not. If it is covered by Rule 11 UA, then FMV computed as per Rule 11 UA. And if it is not covered by Rule 11 UA, then valuation based on valuation report of registered valuer. Simply, we have to take market value. Here, we are not going to receive liability. There will be only asset. Therefore, there is a total of EFGH. There is no minus L. Okay, it's very straightforward. Okay, the stamp duty value or market value FMV should be as on the date of slump sale, as on the date of slump sale. Then how to compute gain or loss? Simply take FMV1 or FMV2. FMV1 means assets which are given, FMV2 means assets which are received. Whichever is higher, that will become your sale consideration or gross sale consideration. From there, subtract transfer expense, brokerage, stamp duty, etc. wholly and exclusively incurred for transferring the asset. Balance will be net sale consideration. From net sale consideration, subtract the net worth of the whole undertaking. FMV1 versus FMV2, whichever is higher, minus net worth. Net worth will comprise of book value, not the market value. Sale consideration will be market value of assets given or market value of assets received, whichever is higher. Here we take FMV or stamp duty value for immovable property, but while subtracting net worth, we take book value of assets minus book value of liability. Long term, short term capital gain or loss. Here the gain or loss can be long term or short term. Any revaluation upward or downward to be ignored for the purpose of 50 clause B. Meaning thereby, normally what people do is that, supposingly, my sale consideration that is higher of FMV 1 and 2 is 300 crore minus net worth, which is my cost of acquisition is 280 crore, or let's say it is 180 crore, then my capital gain long term or short term will be 120 crore. I want to reduce it, I want to manipulate. If I want to manipulate, how can I manipulate? Where exactly I will manipulate? 300 crore I cannot change. If I reduce this 300 crore, my capital gain will reduce. If I make it 200 crore, my capital gain will be only 200 crore. But this 300 crore cannot be changed, cannot be manipulated, because I am going to receive it by way of money. 180 crore I can try to manipulate. What I can do is that if I increase this 180 crore, then my capital gain will reduce. Every increase in the net worth, every increase in the cost of acquisition will tend to reduce my capital gain. So what I will do, how can I increase it? Net worth is nothing but assets minus liability. If I increase the value of assets, then my net worth will increase, capital gain will reduce. Or if I reduce my liability, then also my net worth will increase, net worth increases, capital gain will reduce. So only way to do this is to manipulate by way of revaluing the assets or liability. Government knows all these things. So clarification is inserted in section 50B, saying that revaluation, whether upward or downward, shall be ignored while carrying out value of any asset. While computing net worth, we have to take assets minus liability, assets to be valued as per Income Tax Act and liabilities to be valued as per books of account. While doing so, if it is depreciable asset, take WDV. Depreciable asset, take WDV of the block as per section 43 clause 6. If it is non-depreciable assets, take book value, last point. If it is any capital asset whose entire cost has been already claimed and allowed as a deduction under section 35 AD. What is 35 AD? Capital expenditure on 14 specified businesses like cross-country pipeline network for transportation of crude oil, natural gas, petroleum oil, cold chain facility, agricultural warehouse, warehousing facility for storage of sugar, hotel of 2-star and above, hospital with 100 patient beds and more, certain types of housing project under affordable housing scheme or slum redevelopment project. Where the cost of acquisition of the asset is entirely claimed as a deduction, now cost will be taken as nil. For 35 AD assets, take nil. Depreciable assets, take WDV. For all other non-depreciable assets, all other assets means, any other case means non-depreciable asset, land, jewelry, shares, securities, which are given away, take book value. And if it is goodwill, unless the goodwill is by way of purchase from the previous owner when money was paid, if no money was paid, take goodwill value to be nil. That means either it is self-generated, then also take the value to be nil, or received from previous owner, otherwise by way of purchase from its previous owner free of cost, for free. That means business, goodwill of business or profession acquired otherwise by way of purchase, from previous owner, Otherwise by way of purchase means otherwise by making actual payment. That means either it is self-generated or it is purchased or acquired from previous owner by way of gift, inheritance, irrevocable trust, etc. Then you take the value to be nil. Okay. Then there are some points to be noted. If the WDV becomes negative, that is assets minus liability, assets are worth 300 crore, but the liabilities are 308 crore, then I have a negative net worth. Negative net worth, make it 0, ignore it. CA report will have to be furnished in form 3 CEA. This will be helpful to you in real life, not in exam. In exams, they don't ask questions on form numbers. Will have to be attached or will have to be furnished 1 month before the due date of filing IT return. If IT return filing due date is 31st July, then furnish the certificate by 30th June. If it is 31st October, then furnish it on or before 30th September. Same time limit, just like applicable for furnishing tax audit report under section 44AB of PGBP chapter. Contingent liabilities which appear in the books of accounts, they are also to be ignored, and not appearing in a balance sheet are not to be subtracted, then they are also to be removed. In a sense, not appearing in a books of account means appearing as a footnote, appearing at the end of the balance sheet, appearing as a footnote, then ignore it. Next point, which is little dicey, a part of the undertaking cannot be considered to be the whole undertaking. For the purpose of 50B, 50B cannot be applied unless it is the whole undertaking. However, there are some grey areas here. Even if part of the undertaking is transferred, then also one can go for slump sale provided entire business activity is transferred. I've come across many cases where entire business is transferred, a sole proprietary concern doing business from home. That means his residential house is used as an office premise. In such situation, if everything is transferred except of house, then also slump sale can be adopted. No need to transfer each and everything. So part of the undertaking cannot be considered to be undertaking. This is to be understood not with regards to each and every asset. So when we say that there are 300 assets in the undertaking and slump sale, assessee wants to go for slump sale, that does not mean all 300 assets should have been transferred. What should have been transferred is the business activity in such a way that after transferring those assets under that undertaking, assessee should not be, the selling party should not be in the form of having the ability to continue that business or continue that activity, then it will be entire undertaking. 50B is subject to guidelines given in section 2 clause 42C, which says that sale consideration should not be bifurcated or should not be assigned to each individual asset which is transferred. However, to this rule, there is some exception given in explanation 2 to section 2 clause 42C, which says that if values are assigned by the buying party for the purpose of payment of stamp duty value, or for the purpose of payment of registration charges, then it will not be regarded as assigning the values to each individual asset. Say I purchase your asset, which includes building also. Then when I go to register of properties to register the building in my name, I will have to pay some stamp duty and I will have to pay some registration charges, which is in the form of particular percentage to the cost of acquisition or the purchase price. Their valuation will have to be done, that out of 300 crore paid by me to you, how much is towards this building or how much is towards a particular land. Is this concept mandatory? Answer: no, it is not mandatory. It is optional. Assessee can go for itemized sale to avoid applicability of 50B. Clear? So in your notes, 50B is given this way. So first was capital gain calculation for depreciable asset. Second was 50AA, 4 assets, units of specified mutual fund, market linked debentures, unlisted bonds, unlisted debentures. Slump sale we are done with. So that was situation number, how many situations we are done with? Section 50, 50A, 50AA, 50B. 3 situations we are done with. 2 more to go. Next, slump sale is done. Slump sale is very important. Keep it in your mind. I have given summary of rule 11 UAE also, 115 UAE. Rule 11 UAE is done. Thereafter, next one was stamp duty valuation that we finished in the last session only. Even 50 CA also we finish, 50 D also we finish because they were small. Even 51 also we discussed, where I told you section 51 is unimportant. Next is section 46 and 46A. 46 and 46A. Section 46 is company going into liquidation. You are the shareholder. Company transfers you some asset. That is ideally liquidator. Liquidator of the company transfers you some assets and cancels your shares. Your shares will stand cancelled. In return, company, the liquidator of the company will either pay you some money or will give you some asset. If an asset, say laptop is given to you, you are holding 100 shares, market value is 12,000 rupees. Rather than giving you 12,000 rupees, the liquidator gives you some laptop which is owned by company that okay, take this laptop as a full and final settlement of 100 shares. Then in such situation, in the hands of company, there won't be any liability. There should have been, but there won't be. Company is selling laptop to you or giving away the laptop to you. It amounts to exchange, in exchange of your shares in that company. Then also nothing doing. It will not be regarded as transfer for the company. However, as far as shareholder is concerned, for shareholder, there will be some impact. What is the impact? Whether shareholder receives money or any asset, money or an asset from the company, it will amount to transfer. For company, it will not amount to transfer, 46(1). For company, no tax liability, neither on the company nor on the liquidator, nobody. Company is not transferring anything, though they are transferring you the laptop. However, for shareholder, it will amount to transfer as per section 46 subsection 2. It will amount to transfer of shares in your hand. You have given away the shares. Shareholder of the company in liquidation receives any money or asset from the company, it will amount to transfer of his shares in the company. And accordingly, there will be capital gain. Will be taxed partly under the head other source and partly under the head capital gain. How much under the head other source? Under the head other source, answer yes. Under the head other source, it will be treated as a deemed dividend. Some part of the money received plus FMV of the asset received upon liquidation will be deemed to be dividend under section 2 clause 22 subclause C to the extent of accumulated profits of the company immediately before such liquidation. It will be deemed as dividend. Say you received 10 lakh rupees from the company either by way of money or by way of non-monetary compensation. You received something worth 10 lakh rupees. Out of 10 lakh, something will be deemed as dividend and balance amount will be sale consideration for your shares which you have sold. This is applicable irrespective whether company is a public company or a private company. So let's try to understand this concept with the help of one example. Say section 46, 46(1) and 46(2). 46(1) when company goes into liquidation and the liquidator transfers the assets to the shareholder, distributed to shareholder, no capital gains tax for the company. In the hands of company, nothing will happen. Though it actually amounts to transfer, laptop is transferred to you, depreciable asset, there should be capital gain calculation. But if the company goes into liquidation and it transfers the assets, then it will not amount to transfer. But for shareholder, 46 subsection 2, for example, you are the shareholder Mr. P, you are holding 12% shares of the company, you are holding 12 lakh shares out of 100 lakh shares and company goes into liquidation. As on the date of liquidation, reserves and surplus of the company was 100 lakhs. So out of 100 lakh, what is your share or what is your stake? Answer 12%. 12% of 100 lakh will be 12 lakh rupees. So now you have received check worth 15 lakh and assets worth 10 lakh. Total you have received 25 lakhs. Out of 25 lakh, something will be deemed as dividend. How much? Whatever is your share in the reserves of the company, your share is 12 lakh rupee. 12 lakh rupee will be taxable under IFOS under section 56(2). It will be deemed as dividend as per section 2 clause 22 subclause C, deemed dividend. And then balance amount, balance how much? 13 lakh will be considered under the head capital gain as sale consideration, as a sale consideration. And then capital gain will have to be computed accordingly. Getting this point? For company, nothing will happen, no tax. And for shareholder, shareholder will be partially be taxed under other source and partially under the capital gain. Let's try to understand. He received 25 lakh rupees, 15 lakh by money and 10 lakh rupees worth of other assets. Out of them, 12 lakh rupee will be deemed as dividend under section 2 clause 22 subclause C under IFOS, and 13 lakhs balance amount will be deemed to be the sale consideration of the shares held by assessee. So, in the hands of shareholders, partially taxable under IFOS, partially under the capital gain. 222 subclause C, this talks about taxability of dividend, and then for other assets, it is section 46(2). Okay, next is section 46A. 46A is drastically been changed. Capital gain in case of buyback, buyback of either shares or buyback of securities. Shares and security, again we divide them into two parts. We divide them into unlisted and listed. Unlisted or listed. Okay, but starting with other than shares, buyback of listed securities or unlisted security. So I would remove the word listed, unlisted. Buyback of securities other than shares. As far as shares are concerned, the B point will take care of that. Buyback of listed or unlisted shares up to 30th September 24. Whatever we are discussing for this buyback of other than shares, the old provisions continue, but if it is buyback of shares, then 1st October 2024 onwards, rules have been drastically changed. If it is buyback of listed or unlisted securities other than shares, then it will amount to transfer in the hands of shareholder. Other than shares receives any consideration. Buyback of its securities other than shares, buyback of debentures, bonds, units, etc. It will amount to transfer of such securities in the hands of such assessee. Accordingly, there will be some capital gains tax. As far as shares are concerned, two possibility up to 30th September 24 and on or after 1st October 24. If there is a buyback, then company will be required to pay buyback tax. Company buying back the shares, company, now we are talking only about shares, not talking about other security. Other security other than shares, point number A. There will be capital gains. In the hands of company, it will amount to transfer. In your hands also, it will amount to transfer. And accordingly, you will be liable to pay tax. Whereas buyback of shares, equity ideally or preference, then up to 30th September 2024, companies had to pay buyback tax, BBT, or tax on buyback of shares at the rate of 20% flat rate plus compulsory surcharge at the rate of 12% plus compulsory health and education cess. 23.296% was the effective rate under 115 QA, QB, QC. However, 115 QA, QB, QC have all three been deleted by Finance Act number 2, that is on 23rd July 2024. Nirmala Sitaramanji removed it. Shareholders earlier were exempted from the tax on income arising from buyback of such shares as per 1034A, but 1034A is deleted now, and 46A section has also undergone tremendous changes. So now what will happen on or after 1st October 2024, company will not have to pay anything. For company, nothing payable. No such 23.296%, nothing payable. Earlier company had to pay in the name of buyback tax. Now company has not to pay anything. But as far as shareholders are concerned, you will be surprised to know, say in our example, shareholder received 15 lakhs by way of money and 12 lakh rupees other accessories, other items or other assets. 12 lakh rupees, we bifurcated it this way. FMV of the other assets received 27 lakhs. Out of 20, or maybe this was 10 lakh rupees. So this was 25 lakh. Out of 20, I am continuing with the same example. Out of this 25 lakh, earlier what was happening? Up to 30th September 2024, only whatever was the deemed dividend. How much would be deemed as dividend in our example? Was taxable under buyback tax, and balance amount was exempt as per 1034A. Company had to pay buyback tax on the difference between amount paid by company to the shareholder minus amount received by company from the shareholder. Buyback tax is deleted now. So we'll not discuss further about it. I have a separate video recorded for buyback tax. Please have a look at it. It's a beautiful video. Now what will happen? On or after 1st October 2024, company will not be regarded to pay buyback tax. Nothing payable by company under any, but TDS under section 194O will be applicable. Sorry, only 194, not 194O, at the rate of 10% if the amount of dividend exceeds 5,000. 1034A no more allowable. So for company and for shareholder, what will be the impact on or after 1st October 2024? No buyback tax at the rate of 23.296%, but there will be TDS under section 194 at the rate of 10% of the amount paid by company. And for shareholder will now be taxed in the following manner. You might be thinking that out of 25 lakh received, something should go under the head capital gain and something under the head PGBP. For the shareholder I am talking about, something under PGBP or IFOS, logically speaking, but it will not be completely that way. Entire 25 lakh will be deemed as dividend under section 2 clause 22 subclause F. Up till now we had deemed dividend, 5 types of deemed dividend, 222A, B, C, D, E. One more clause has been inserted, subclause F. So dividend will be taxable, entire amount will be considered as dividend, entire amount, entire 25 lakhs in our example. Though some part is capital in nature, then also it will be deemed as dividend and pay tax. No deduction for any cost of acquisition of shares will be allowed. No deduction allowed for the cost of acquisition of shares. No deduction for any expenditure incurred under section 57 clause 1 to earning such income. So meaning thereby, if entire 25 lakh is considered here, then entire 25 lakh will be under IFOS. Nothing will go under the capital gain. If there is a buyback on or after 1st October 2024. Remember the date here. This is the big amendment. And no exemption under 1034A, because 1034A stands abolish. It's been deleted now. Okay. So what will happen is, section 46A should be applied or not. This point we have discussed in IFOS chapter also. So under section 2 clause 22 subclause F, it will go under the IFOS and dividend should be taxable under IFOS. But because of this removal of buyback tax, section 46A was amended stating that, and 222F was introduced stating that now entire amount will go under the head IFOS, nothing under the head capital gain. So under the head capital gain, what will happen is, sale consideration will be nil, and cost of acquisition will be equal to, let's say you bought it for 12 lakh share, 12 lakh rupees. Entire 12 lakh will turn out to be a capital loss, short term or long term depending upon period of holding. Entire loss will be allowed to be set off against other capital gains, but nothing will be allowed against this deemed dividend. Deemed dividend under section 2 clause 22 subclause F, entire 25 lakhs in our example will be chargeable to tax as per slab rate. Buyback of shares will be considered as transfer of shares in the hands of shareholder. Sale consideration will be nil. This will result into capital loss. In such situation, government says you can set it off against deemed dividend. You cannot set it off against deemed dividend. Barring deemed dividend, it can be set off against other capital gain, short term or long term depending upon period of holding. Balance capital loss can be carried forward for a period of next 8 years. So with that, section 46A comes to an end with all the 9 situations of special calculation or special situations for calculating capital gains come to an end. Now the next is section 54 series, exemption under section 54 series. There are 8 exemptions. Earlier there were 9. Last one was 54 GB, which is now deleted. So how many exemptions are left? As of now, section 54, 54B, 54D, 54 EC, 54 EE, 1, 2, 3, 4, 5, 54F, 54G and 54GA. Out of them, questions come up in the exam only on section 54, 54 EC and 54F. Only these 3 are actually relevant from exam perspective. This we know pretty well. Section 54 and 54F are only for individuals and HUF, not for others. 54 EC is for everyone, individual, HUF, AOP, BOI, company, anybody can claim exemption under section 54. 54 EC. Section 54 says you sell residential house, buy another residential house within a particular time period. What is the time period? In case you are purchasing, then the time period to acquire the asset is purchase either 1 year before the date of sale of the current asset, this particular house. House 1 is sold, house 2 is acquired. House 2 is to be acquired within a period of 1 year before the, it is to be, if you are purchasing, then 1 year before the sale of this house or 2 years after. 2 years after. In case you are constructing it, then the time limit is 3 years. Within 3 years after the date of transfer of house number 1. However, mind you, those who are constructing, there is no concept of 1 year before. It's only 3 years after. So, only if you are purchasing, then there are 2 time limits, 1 year before, 2 years after. But if you are constructing, then there is only 1 time limit. Remember that. Now, this 54 is available only to individual HUF. The house which is sold should be long term. It could be a residential house along with land, that is land upper tenant there too, or there could be only a residential house without any land, but there has to be a residential house. Here we are not talking only about plot of land. If only land is transferred, then this exemption is not available. Then one can claim 54F, but for 54 section, there should be sale of house and purchase of house. House has to be there. Whether land is there adjoining to the house, land is there or not there, house should be there. It should be long term. That means period of holding should be more than 24 months. Within this time limit, new houses to be purchased or constructed. Then there are various case laws which clarify certain things, that house 1 was in the name of husband, which is transferred in a single name of husband. The new houses purchased in a single name of wife, then also exemption allowable. There is another case law which says house was in the name of husband, new houses purchased in the name of husband plus wife, then also entire exemption can be claimed by husband. We have supporting case laws like that. For every section, we have some or the other case law. Now, starting with section 54. Section 54.1, 8 points we will be discussing for each section. Number 1, who should be the assessee? For section 54, assessee should be either individual or HUF, whether resident or non-resident. Even non-resident individual HUFs can also claim this exemption. Many people are not aware of that. So, let me tell you, it is available not only to residents, it is available to non-residents also. Which asset should have been sold? The answer, residential house along with land upper tenant there too. If it is upper tenant to the residential house, only land not covered here. Asset transfer should be long term. New asset should be one house in India, one residential house in India, and with effect from AY 24-25, some upper limit is also imposed here, that the cost of acquisition of the new house should not be more than 10 crore, maximum up to 10 crore. If it is more than 10 crore, then about 10 crore will be excluded. So, if I am selling my one house, that means this benefit is only to upper middle class people. Poor people, lower middle class people and upper middle class people. Those who are rich and super rich or ultra rich, they will not be getting benefit beyond 10 crore. First 10 crore benefit will be available. Meaning thereby you are buying a new house for rupees 24 crore. You are a Bollywood celebrity, or you are Hollywood, you are some celebrity and you are buying some house for 24 crore rupees, then out of 24 crore rupees, exemption can be claimed only to the tune of 10 crore rupees of investment. Any investment above 10 crore will be excluded, will be ignored. So, if I am buying a new house for 24 crore, that doesn't mean exemption will be denied to me in totality. Not in totality, exemption partially will be available up to first 10 crore of investment. Above 10 crore will have to be ignored. Just keep it in your mind. It should be one house and that too in India. However, as far as one house meaning is concerned, we had discussed one case law which say that assessee wanted to buy one house only, but he did not find one house. So, he bought two houses, flat number 401, flat number 402. This is the entrance, this is the entrance. Here, he demolished the wall in between and converted it into a one single flat. He bought these two flats from two different people by way of two different two different sale agreement or purchase agreement, then also no problem. This will be considered as one house only. This entirely two houses combined together will be considered as one house if there is a unity of structure. What do you mean by unity of structure? Unity of structure means either the houses are adjoining to each other, that means they are in a form of joint flats, or there is a duplex or triplex. Then in such situation it will be called as a case of unity of structure. Accordingly, exemption can be claimed on both the houses combined together by treating them as one single house. Now many people had complained about this, that why this restriction of only one house? What if I want to buy two small houses? Say I am shifting from city to village. Okay, then I am buying two small houses not adjoining to each other. I am staying in a joint family. Now I want to separate and buy two flats, one for myself and one for my son or my family member, and I want to segregate. In such situation, government said, okay, no problem. They introduced first proviso 1 to section 54, saying that in case if the LTCG amount of LTCG is up to 2 crore rupees, which amount? Not sale consideration, but capital gain amount, which has to be long term only, is up to 2 crore rupees, then exemption under section 54 will be available not only for purchase of one house, but will be available for purchase of two houses instead of one. So earlier, what was the rule? If you sell one property, buy two properties, two residential houses, unless there is a unity of structure whereby both the houses will be considered as one single. In case you are selling one house and buying two houses, then you can't consider both the houses for claiming exemption. You make a choice, select any one of them and claim exemption on that particular house, ignore the cost of acquisition of the other house. And now government says, as per first proviso, you can claim exemption on purchase of two houses, provided your long-term capital gain is up to 2 crore rupees and you are buying two residential houses at two different places. Both can be considered for exemption. However, as per proviso 2 to section 54, whatever we discuss is optional. That is given in proviso 1 only. Optional. If assessee doesn't want to do it, he may not do that. If he wants to do it, then only. However, as per proviso 2, this is once in a lifetime opportunity. Once in a lifetime. That means once assessee has done this, he sold one house, bought two houses, of course residential house, then with all other conditions fulfilled, then he cannot do this for the second time in his whole life. He can do it only once. That is what it is. And third proviso to section 54 talks about maximum 10 crore upper limit. Maximum 10 crore, that what is this? This 2 crore was for long-term capital gain amount and 10 crore is for claiming exemption, or 10 crore is a upper limit for cost of acquisition of the new residential house. Exemption is available only to individual HUF. Okay, if is in case you are purchasing it, then there are two time limits, 1 year before or 2 years after, and in case you are constructing it, then within 3 years after. In case you are not buying, you are purchasing the property, you are buying it, but in an under construction building, then which category would you fall under? You will fall under purchase category or construction category. Why do we need to decide this? Whether you are purchasing or constructing. In case you are buying a house in an under construction building, then you are purchasing or you are constructing. Answer, you are purchasing, you are not constructing. When we say construction time limit is up to 3 years, that means you are yourself constructing it. Then time limit is 3 years. Okay, how much to be invested? So what is to be invested is the amount of capital gain. Amount of capital gain which has to be long term. And in case more than 10 crore is invested, then above 10 crore we ignore. Lock-in period of 3 years will be applicable for the newly acquired house. You can't sell it for the next 3 years. If you sell it, then the capital gain claimed earlier will have to be reversed. And capital gain account scheme benefit, answer yes, available. What is capital gain account scheme? After you sell the asset, earlier asset, house number 1 which is sold, before you could buy the asset or before the expiry of the time limit to buy the asset, you have a lot of time limit, 1 year before or 2 years after, especially this 2 years after or 3 years after. Within this time limit, before expiry of this 2 years or 3 years time limit, if there is a due date to file IT return approaching, then exemption will be available only if assessee opens a special account with some nationalized bank or a specified bank, authorized bank, called capital gain account scheme, CAGS, Under that scheme, assessee will have to open a separate bank account, which will be like FD account, and assessee will have to deposit all unutilized amount in that account. Then only this exemption will be available. Many people are not aware of this, and they accidentally or unknowingly end up losing the exemption just because they did not open this account and did not deposit in this capital gain account scheme. Okay, then first proviso to section 54(1) we are done with. Second proviso also done with, and third proviso also done with. Okay, first proviso says that assessee at his own option, if the LTCG does not exceed 2 crore rupees, he can purchase 2 residential houses instead of 1. And second proviso says that this is once in a lifetime benefit. Third proviso says investment in a new house exceeding 10 crore will have to be ignored. Not entirely, about 10 crore ignore. Then we have some case laws also which we will be discussing. Before that, next is section 54B, again available to individuals and HUF. This is available with regards to agricultural land. The first asset was residential house, second is agricultural land. What is to be sold is agricultural land. Which area? Agricultural land in an urban area or in a rural area? So answer, naturally it has to be in an urban area only. Reason? If it is in a rural area in India, then as per definition of capital asset given in section 2 clause 14, the capital asset definition, there are some exceptions, 4 exceptions. Out of the 4 exceptions, whereby the given asset will not be regarded as a capital asset, one of the exception is rural agricultural land. Rural agri land, meaning thereby if it is in a rural area, then question of claiming exemption under section 54B does not arise only because it's not a capital asset. 54B exemption will arise only when the given asset is an urban land, urban agricultural land, and you're selling it. However, not only the characteristics should be urban agricultural land, it should be agricultural land, but not only by virtue of its characteristics or by virtue of its registration, it should have actually been used for agricultural activities, for cultivation purpose by individual or his family members. If he is individual or his HUF, then by family members. Land should have actually been used for agricultural activity. For how many years? The answer, for a period of 2 years. For a period of 2 years prior to the date of transfer. For a period of 2 years immediately preceding the date of transfer, it should have been used for agricultural purposes by assessee or his family members. Okay. In one of the cases, what had happened was, assessee claimed that he has used it for agricultural purposes for 2 years. Department or AO had a doubt, so AO contacted ISRO, Indian Space Research Organization, and through satellite images of that particular land, ISRO reported it to Income Tax Department, and this land was a barren land, could not have been used for agricultural activities at all. It was unused land. In such situation, exemption was denied. The gain should be long term or short term, anything is fine here. Okay. But what is to be purchased is another agricultural land. So ideally, section 54 and 54B, common point is that whichever asset is sold, same asset or same type of asset is to be acquired. For section 54, you sell residential house, buy residential house with a higher time limit. And here in 54B, sell agricultural land, buy another agricultural land within 2 years after. There is no before time limit. What is to be invested is the amount of capital gain, just like section 54. Everywhere capital gain amount is to be utilized. For example, your sale consideration is 103 lakhs, less transfer expense, brokerage, etc. is 3 lakh rupees. Net sale consideration therefore will be 100 lakhs. And now cost of acquisition, or maybe index cost of acquisition, whatever you subtract, is supposedly 70 lakhs. Then the LTCG capital gain will be 30 lakhs. How much should be? Either you pay tax on 30 lakhs or you invest this 30 lakhs somewhere and claim exemption. How much is required to be invested in the new asset? So everywhere for all the section, this amount is to be invested, 30 lakhs. Only section 54F, you need to invest 100 lakhs for 54F. For 54F, invest 100, claim exemption of 30. Everywhere else, for all other section, invest 30, claim exemption of 30. If you invest 29, you get exemption of 29. But section 54F is the only section where higher amount is required to be invested. What is to be invested is net sale consideration. If you invest 100, you get exemption of 30. If you invest 50, you get exemption of 15. If you invest 60 lakhs, you get exemption of 18 lakhs and so on in that particular proportion, in this proportion, only for 50 for F. There is one more section, 50 for GB, but now 50 for GB is deleted, therefore we will not talk about it. Lock-in period will be 3 years from the date of acquisition and capital gain account scheme benefit will be available. If you are not able to utilize for the new agricultural land on or before the due date of filing IT return, 31st July or 31st October, and your time limit is still available to invest, but your IT return due date time limit is expiring, then you open this account and deposit here, otherwise benefit of exemption will be lost forever. 54D. 54D, in section 54 we had to transfer residential house, 54B agricultural land, 54D industrial land building. Everything is revolving around land building, landlord building, but here it is industrial land. First it was residential, second one was agricultural, third one is industrial. Should have been used for industrial purposes for a period of 2 years, just the way we discussed for agricultural land that it should have been used by assessee or his family for the purposes of agricultural activity for a period of 2 years prior to the date of transfer. Same way here, the industrial land building should have been used for the purpose of industrial activity for a period of 2 years or more than 2 years prior to the date of transfer. And there is one extra condition which is not there for other section. Such industrial land building should have been compulsorily acquired by government under any law for the time being in force. Right? Again, just like 54B, the status could be long term, short term, anything. What is to be purchased or acquired or constructed? So answer, you are selling industrial land building to government under compulsory acquisition. Now you buy another land or building. Another land, as far as land is concerned, it cannot be constructed, it can only be acquired. To acquire new land, and as far as building is concerned, it can be purchased or it can be, it can be acquired or it can be constructed. So either you purchase new industrial land building or construct the new building for industrial purposes, factory, etc. Within 3 years, what is this? This is time limit to acquire. Within 3 years, you acquire from the date of transfer of the earlier asset. What is to be invested? Amount of capital gain. Lock-in period will be 3 years from the date of acquisition and the capital gain benefit scheme will be available. Again, that 54B and 54D are less important. Question would have barely come. 54 EC is an important section. 54 is also important. 54 EC, why is it important? Because it is available here, exemption is available to any assessee, individual, HUF, AOP, BOI, company. Ideally, when a question is on company, they can claim 54 EC, they can claim others. 54, 54B, 54D, all three are available to individual HUFs. 54D is for any assessee, but 54D is applicable only when there is a compulsory acquisition. So it's not uniformly or openly available to everyone, only in case there is a compulsory acquisition. 54 EC is a most welcome section. 54 EC is available, once upon a time it was available on transfer of any asset, any long-term asset, land, building, plant, machinery, jewelry, anything. Now it is available only on transfer of land, building or both. Which land building? Industrial, residential, agricultural? Answer, any. Any land building. Any land or building, and not only industrial land building. So section 54 was residential house, section 54B is agricultural land building, agricultural land, and 54D was industrial land building. And now 54 EC is for any land building, industrial, residential, only land is also fine, only building is also fine, land plus building is also fine, or any kind of characteristic. Asset should be long term, that means period of holding should have been more than 24 months. And then what is to be acquired? Assessee will have to acquire any of the following 4 types of bonds, either NHAI, National Highway Authority of India, Rural Electrification Corporation Limited, RECL, or Power Finance Corporation Limited, PFCL, or IRFCL, Indian Railway Finance Corporation Limited, any of these bonds within a period of 6 months from the date of transfer of the earlier asset. Here, lock-in period is very high, 5 years, but what is to be invested is amount of capital gain But here, just like section 54, here there is a capping of 50 lakhs. Maximum 50 lakhs during the current financial year and the immediately succeeding financial year, that is next year. Current year plus next year combined together, investment should not be more than 50 lakhs in any of these bonds. NHAI, RECL, PFCL, IRFCL. However, limit of 50 lakh is a yearly limit. It is not a limit for each type of bond. It's not you invest 50 lakhs in NHAI, 50 lakh in RECL, 50 lakhs in PFCL, 50 lakhs in IRFCL. No. Combined together for all the 4 types of bonds, 50 lakhs combined together. 50 lakh is not only the limit for the current year, it is for the next year to current year, next year, investment in current year, next year combined together. Lock-in period of 5 years will be applicable instead of just 3 years for all other assets. Everywhere it is 3 years. Here it is 5 years since 1st April 2018. And the time limit to acquire is also 6 months. Lock-in period is also 5 years. The highest lock-in period is available here or applicable here, and the lowest amount of time period to acquire. Capital gain account benefit scheme is not available because the time limit to acquire itself is 6 months, which is very close to due date to file the IT return. 54 EC is exactly 54 EC is an important section, and it is exactly same as 54 EE, but 54 EE is less important. I'll tell you why. It is available to any assessee just like 54 EC. Both are on the same lines only. It's just that in 54 EC, you have to acquire specified bonds of any of the 4 government organizations or government companies, IRFCL, PFCL, NHAI, RECL. Here you have to acquire units, specified units, not each and every unit. These units are not available only in the market, or nobody knows when were these units allotted or issued and when did the issue got over. Nobody knows anything. Therefore, this is unimportant section. Our institute has also never asked a question on 54 EE. The next section 54 F is important. Here assessee could be anybody and the asset could be any long-term asset, any asset. Could be land, building, industrial, residential, commercial, it could be office premise, it could be just a plot of land, it could be jewelry, shares, debentures, bonds, anything. But the gain should be long-term. Status of the asset should also be long-term. What is to be acquired is units notified by central government, which are issued up to 31st March 2019. As of now, these units are not available. Within 6 months, same time limit just like section 54 EC, 6 months from the date of acquisition, date of transfer of the previous asset, not acquisition. What is to be invested is the amount of capital gain with the same capping limit as applicable for 54 EC, that is 50 lakhs in the current year, the year in which the earlier asset is transferred. Invest 50 lakhs in the current year and the next year combined together. Maximum 50 lakh can be utilized. Lock-in period of 3 years will be applicable from the date of acquisition, and capital gain account benefit scheme is not available for these two sections, 54 EC and 54 EE, for a simple reason that time limit to invest is barely 6 months to acquire the new asset. Since the time limit is 6 months, which will coincide with your IT return due date. So IT return due date and the 6 months time limit both would be expiring at the nearby same period. There could be a gap of 1 or 2 months here there, but then ideally time limit will be expiring exactly at the same time. Okay, now 3 provisos for section 54 are done with. There are some points to be noted which we are already done with. First point is about lock-in period. Lock-in period. Second is about 50 lakh rupees of cap, second and third point. Second proviso to 54 EC and second proviso to 54 EE, 50 lakhs cap, that we already discussed. Okay. Now, wherever there is a lock-in period, in case if the newly acquired asset is transferred or sold within the lock-in period, then the exemption given earlier will have to be reversed. Exemption will be denied. But no need to go backwards to the year of acquiring or selling the asset. Say I transfer the asset in 2022-23, I acquired, new asset acquired and exemption claim under section 54. Now in financial year 24-25, I have not completed 3 years. Before expiry of 3 years, I am selling the asset. Before 3 years expiry, I am selling of the asset. That means I am violating the condition. If I am violating, I will be punished. Question number 1. Who will be punished? Answer, given assessee who purchased this flat and who is selling this asset. Second, in which year there will be punishment? Answer, no need to go backwards. Don't do that. Punishment will be in the year in which the violation takes place, namely 24-25 financial year, AY 25-26. What will happen now? So here I claim exemption under section 54F for 87 lakhs. Now what will happen? Now here in 24-27, 24-25, 87 lakhs will become taxable. But how it will become taxable? So there are two ways. Either 87 will directly be taxable as long-term capital gain, directly taxable. For some of these sections it will be directly taxable. Some of the section it will be indirectly taxable. How indirectly? So for some of these sections, the amount of capital gain which was claimed as exemption, amount of exemption claimed in year 22-23 will be reduced from the cost of acquisition of the new asset. So new asset was acquired here, acquired for let's say 2 crore, and by acquiring 2 crore worth of asset, 87 lakhs of exemption was claimed. Now this 200 lakh worth of asset, 2 crore worth of asset, the new asset is sold. So first of all, find out at what price sold. Supposing it is sold for 220 lakh minus cost of acquisition, assuming it's a short term, or even if it is long term, indexation is no more allowed. So it was acquired for 200 lakh. This 20 lakh is a fresh capital gain, which ideally would be short term, or even if it is long term, whatever may it be. Fresh 20 lakh is taxable. This is the capital gain now accruing. This will definitely be taxable. Plus there will be 87 lakhs taxable. Total 107 lakhs will be your capital gain. Out of them, this could be short term, this will be long term, or earlier one could be long term. This fresh 20 lakh could be long term, and the earlier one is long term. We know pretty well. 107 will be taxable. This is called directly taxable. In case if the newly acquired asset is transferred within the lock-in period, then this is what will happen. What do you mean by indirectly taxable? Indirectly taxable means what? For some of the section it will indirectly be taxable. Say sale consideration of the new asset is 220 lakh. Cost of acquisition, which was 200 lakh, will have to be reduced by the exemption claim under section 54. Section 54 exemption was 87. Cost of acquisition will now become 113. And accordingly, there will be capital gain of 107. This is called indirect way. Answer will be same, 107. But what will happen is, here entire 107 will become short term capital gain if the given asset is short term. Second asset which was recently acquired for claiming exemption, if that asset is sold within 2 years time period, within 24 months time period, then the gain will be short term. Here entire 107 will be short term when it gets taxed indirectly. If it directly gets taxed, no, then this fresh 20 lakh will be short term. Could be long term also, but ideally short term, and this 87 lakh earlier capital gain exempted will be long term. Are you understanding what is the difference between directly getting taxed and indirectly getting taxed? Okay, so for the purpose of section 54, 54B, 54D, 54G, 54GA, for this section it will be indirectly taxable. Indirectly by way of reducing it from the cost of acquisition of the asset sold. And for this section remaining 54 EC, EEF, GB is deleted, so I am cancelling it, will straight away become chargeable to tax in the year in which this condition is violated. What is capital gain account scheme that I have explained you? No need to revise it. Okay. Then this clarification is unimportant, that in case you are buying some bonds, especially rural electrification company or corporation, RECL, or NHAI, National Highway Authority of India. Once upon a time, these two bonds, NHAI, RECL, were eligible for ATC also. then this clarification was applicable that once you claim exemption under this section 54 EC, you cannot claim exemption or deduction under section 80C on the same bonds. The same bonds were giving me two different benefits. Simply I can claim only one, any one, not both. This is basically to avoid double benefit. 54H, which is slightly important, it says for the purpose of these sections, time limit to invest is 2 years, 3 years, etc. or 6, whatever may be the time limit, but time limit starts from the date asset is transferred. Whatever is the time limit that we discuss, time limits are to acquire from the date of transfer of the old asset, transfer of the asset sold. So and so time limit is time limit from the year or from the date of transferring the earlier asset. Now the question is, what if there is a compulsory acquisition? Compulsory acquisition and the money is not entirely received by me, and a tick 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 meter is already put down, counting is already started, but I have not been able to acquire the asset because there is a compulsory acquisition and I have not received the money. Compensation is not yet received at the time of transfer. Then 54H, it says don't worry, your time limit to acquire another asset for the purpose of claiming exemption for that much part which is not received right now will start from the date on which it is actually received. Time limit given in respect of that much part which is not received will be calculated from the date of receipt of such part of compensation and not from the date of transfer. As we discussed, there are 8 exemptions, or there are 8 sections, out of which we are done with 5. Now 54F, 54G and 54GA. Only 54F is important, rest 2 can be ignored. Exemption available to individual HUF. This is exactly opposite of section 54. In section 54, what do we do? Sell residential house, buy residential house, only one, and that too in India, within 1 year before, 2 years after, or 3 years after. Section 54F, it says the asset which you are transferring should be any long-term asset, sell any long-term asset other than residential house. Other than residential house, and buy residential house. Buying is of the same asset, but the asset which is to be sold for 54 should be residential house, and for 54F it should be anything other than residential house. Other than residential house, like you sell office premises, factory, shop, showroom, godown, jewelry, equity shares, bonds, debenture, units, anything other than residential house, but it should be long term, of course. And you buy residential house with the same time limit. If you are purchasing, then 1 year before, 2 years after. 1 year before, 2 years after. If you are constructing, then 3 years after. Same concept, just like 54F. Here also capital gain account scheme benefit is available. Lock-in period again 3 years. The newly acquired house should be in India. This should be in India. It should be only one residential house. If you are buying more than one, then ignore the second one or ignore any one of them. Only any one of them can be used. As far as section 54 was concerned, if you recollect, there was an option as per proviso 1 and proviso 2 to section 54. There was an option available that instead of buying one house, he can buy 2 houses if the amount of LTCG is up to 2 crore, and it was optional to consider or to buy 2 houses and claim exemption with regards to both the houses, and it was once in a lifetime opportunity as per second proviso. So is not the case in case of 54F. 1 means only one. There is no concept of claiming exemption with regards to 2 houses. But here, apart from that, there are other conditions also, other conditions with regards to another house, with regards to another house other than the house which is purchased. So what is that restriction? I'll tell you. But before that, I hope you are clear with the time limit to acquire the new house. Any long-term asset other than residential house. Other than residential house could be anything. Should be long-term. Buy what? The answer, purchase one residential house in India. One residential house in India. And here also, just like section 54, 10 crore rupees of upper limit has been imposed. Any cost of acquisition of the new house or cost of construction above 10 crore shall be ignored. It doesn't say exemption will be, it does not say exemption will be up to 10 crore. Exemption will be less than 10 crore only, where it says the cost of acquisition of the new house exceeding 2 crore rupees, above and over 2 crore rupees will have to be ignored. If purchased then within 1 year before or 2 years after, constructing then within 3 years after. What is to be invested is the amount of sale consideration. I have highlighted it here. This is the only place where sale consideration is to be invested instead of capital gain. Everywhere else capital gain amount is to be invested. Amount invested exceeding 10 crore will have to be ignored. Lock-in period of 3 years will be applicable from the date of acquisition, and capital gain account benefit scheme will be available, but again restricted to maximum of 10 crore rupees. Now, first proviso to section 54F, this is important. It says that you sold, let's say, a plot of land, commercial land sold, and to claim exemption you bought residential house number 1 acquired for the purpose of 54F. This is RH, means residential house. Max 10 crore. Agreed, no problem. Now, apart from this particular house which is newly acquired or newly constructed for the purpose of claiming exemption under section 54F, ignore this house. Other than this house, assessee should not have more than one house. Assessee should not, there are conditions. These conditions are found only in 54F, no other section. Assessee should not own more than one house in his own name other than this particular one. So he can own one house. Say he already has one house as on the date of buying this. So max 2 houses, one which he already owns, second which is now buying. Okay. Then assessee should not acquire or purchase another house commercial property, no restriction. He can buy another commercial property. He can buy office, factory, shop, unlimited number of properties he can acquire. As far as residential houses are concerned, he cannot own more than one house, cannot acquire another house for a particular time limit, and cannot construct another house, another residential house for a particular time period. He should not own more than one house. Owning one more house is allowed. So he can have 2 houses, one newly purchased, house 1. He can have another house as on the date of transfer. As on the date. Should not acquire another house within next 1 year. Should not construct another house within next 3 years. Assessee should not own more than one residential house. One he can, other than the newly purchased, as on the date of transfer. Should not purchase within 1 year after the date of transfer. Should not construct within 3 years after the date of transfer of the original asset. Otherwise, what will happen? Otherwise, in situation number A, exemption will be denied. Exemption only will not be available. And situation B and C, exemption is already granted. B and C are future related condition, and condition number A is a present condition to be fulfilled right now. If not fulfilled, then exemption will not be given only. And as far as B and C are concerned, they are future related condition. Whenever violated, at that time capital gain will have to be reversed. Second proviso to section 54F, which is again important, just like section 54, here also upper limit of 10 years. Acquisition of more than 10 crore rupees. More than 10 crore rupees utilized to acquire another property exceeding 10 crore will have to be ignored. Okay, and last 54G and GA, last 2 section, these are both same only differences available to any assessee. Here what is happening is, under 54G, assessee shifting is industrial undertaking. Both the section, the asset is same, asset which is transferred should be industrial undertaking. Industrial land, building, plant, machinery, that is industrial undertaking. Here in 54G, assessee is shifting his industrial undertaking from urban area to a rural area, urban to rural. But in 54 GA, he is shifting from urban area to SEZ area, special economic zone area. Assessee owns which asset is transferred? Plant, machinery, land building. Plant, machinery, land building, which is used by assessee for the purpose of industrial undertaking situated in an urban area. Situated in an urban area. Long term, short term, anything is fine. What is to be acquired or what expenditure to be incurred? Answer: either acquire new land building, new plant machinery land building in a rural area in which industrial undertaking is shifted, or assessee should have incurred expenditure on shifting. This is the only place where assessee is allowed deduction or exemption with regards to shifting expenditure also, though he may or may not be buying a new house, a new property, or maybe he is buying, but he is incurring expenditure on shifting also. Some old plant machinery shifted from urban area to a rural area, then also expenditure on shifting will also give assessee some benefit. You should have purchased or acquired or constructed new plant machinery land building in a special economic zone from urban area. So what is the difference between 54G and GA? Both are same only. It's just that in 54G, assessee is shifting from urban area to rural area, and in 54GA, he is shifting from an urban area to SEZ area, special economic zone area, with the same time limit, 1 year before, 3 years after, 1 year before, 3 years after. Amount of capital gain is required to be invested, and there will be lock-in period of 3 years under both the situation. Capital gain account benefit scheme will be available. Now, capital gain account benefit scheme, capital gain deposit scheme benefit is not available in case of 54EC and 54EE. Barring that, benefit is available for the remaining 6 sections. Okay. First and second proviso of 54F are done. It says G and GA both similar to each other. The only difference is from in one case it is shifting from urban to SEZ, and in one case it is shifting from urban to rural, urban to rural, urban to SEZ. That is only difference. Then point number 4, 5, 6, we have some case law 4, 5, 6, 7. We have different types of case law. Case laws we are already done with in the regular class. Only fourth point, Supreme Court decision is very important. It says Supreme Court stated in case of fiber boards, said all these time limits, whatever is given, are not the time limits for acquiring the asset. These are the time limits for making investment. It says whatever is the amount of capital gain amount is to be utilized for making investment. Meaning thereby, even if I don't receive the possession of the new asset or newly acquired asset, I have not received possession, but my amount is utilized. I have made payment, maybe part payment I have made, but possession is not received, property is not transferred in my name, then also no problem, exemption will be available. Time limits given above are for utilizing the amount of capital gain or utilizing the amount of net sale consideration in the eligible asset, and are not the time limits for acquiring the eligible asset. Time limit is not to acquire the asset, time limit is for making investment or utilize the capital gain amount in acquiring this asset. If the eligible asset is not acquired or received within the stipulated time, but some advances paid to the vendor within the specified time limit of 1 year, 2 year, 3 year, then the amount of advance given will be eligible for claiming exemption to the tune of whatever payments are made. Okay. Then Ananda Basappa, 2009 Karnataka High Court, and KG Rukmani Amma, Karnataka High Court, and Sayyad Ali, Andhra Pradesh, same lines. All the 3 case laws on the same line. If there is a unity of structure, then 2 flats can be considered as one single flat. If there is a unity of structure, this we are done with. Next one, Gurnam Singh, and even the next to next, and even this Kamal Vahal. Both the cases, what had happened was, assessee sold one property in his own name and bought another eligible asset in the name of another family member. No problem. Court said it is not mentioned in any of these sections that as to in whose name the new asset should be acquired. Therefore, new asset could have been acquired in the name of anybody. Old asset was in the name of Mr. X, new asset is in the name of Mrs. X, no problem. Still exemption will be available. Old house was in the name of Mr. X, single name. Now the new house is purchased in the name of Mr. X and Mr. Y, his son, then also no problem. Exemption will entirely be available to Mr. X. If the old asset is transferred was in a single name of the assessee and the new asset is acquired for the purpose of claiming exemption is acquired in the joint name of assessee and his son, no problem. However, payment was entirely made by assessee from his own bank account. Whosoever makes payment will get exemption to the tune of whatever amount he has invested. Son's name was added only for nomination purpose, so that if something happens to father all of a sudden, the assessee, then assessee's son will not have to go through this lengthy procedure of getting property transferred in his name. AO allowed exemption only to the tune of assessee's share in the new flat. However, exemption will be allowed entirely to the tune of entire cost of acquisition as much as is met by assessee. Similarly, old asset was in a single name of assessee. New asset is acquired in the single name of his wife due to Parkinson problem. Earlier situation, what happened? Gurnam Singh, assessee, sold personal property, acquired new property in his own name and son's name combined together, joint name. Now here what is happening? Assessee sold his property, acquired in the name of new property, acquired in the name of some other person, in the name of his wife, because he was having Parkinson problem. Then also assessee can claim exemption as the condition of utilizing capital gain in a new asset within stipulated time has been satisfied. It is nowhere mentioned that the above sections that the new eligible asset should be in the name of assessee only, could be in the name of somebody else also. Hindustan Unilever, this is also something you need to remember, Bombay High Court decision. No need to remember citation, remember at least the matter, whatever is the matter. Okay, this is the last point. I think after this we are done with the remaining part of the chapter. Okay, now here Hindustan Unilever, they acquired bonds of NHAI under section 54 EC within 6 months. They made payment in the 5th month, but the check also got cleared before expiry of 6 months. Before expiry of 6 months, they made payment made, check is also cleared, same is reflected in the bank account, receipt has also been issued by NHAI people. Then exemption cannot be denied just because bonds are received after 6 months or bonds are issued after expiry of 6 months. For a reason that the time limit of 6 months is not to receive the bonds. Time limits, same thing Supreme Court in fiber boards, first point which we had discussed. Where was it? Fiber boards, 4th point. Supreme Court also reiterated the same thing, and earlier to that Bombay High Court in case of Hindustan Unilever stated that the time limits are for making investment, not to acquire the asset. Right? That's why exemption will be not denied. That's it. With that, revision of capital gain chapter comes to an end. Thank you very much. See you in the next video. In case you have yet to finish any video, then please do finish watching all the videos. I've got around 50 plus videos on different chapters, okay, which is one of the highest coverage. Wish you all a very good luck. All the best. Take care.